Are you starting a business and stuck on whether to go for a sole trader or a limited company? It's one of the first and most important decisions you'll make, but choosing wrong could cost you, not just in money, but in time and effort. Hi, I'm Michelle, and in this video, I'll break down the differences, the pros and cons, and even run through a tax calculation example to help you make an informed decision. Stick with me to find out which structure suits your business best. So let's start with the sole trader option. As a sole trader, you and your business are legally the same entity. There is no separation. This is the simplest business structure and it's quick and easy to set up. Some of the advantages are, firstly, all decisions are yours. Secondly, you have full control of your profits and you can take money out whenever you want. It's called drawings. Thirdly, there's minimal paperwork involved and accountancy costs tend to be lower. But there are also some disadvantages. First of those, you have unlimited liability, which means if your business has debts, your personal assets like your home can be at risk. Secondly, as your income grows, you might pay higher tax as a sole trader compared with a limited company. And then lastly, you're taxed on all the net profit, regardless of how much you've actually taken out for your personal use. So it is ideal for someone starting small or working solo, but it might not be the best option for scaling or for risk-heavy businesses. Now, let's talk about a limited company. This structure makes your business a separate legal entity from you as an individual. It's like you created a brand new person with its own name, tax reference number, and bank account. Some of the key advantages are, firstly, limited liability. Your personal assets are protected if the company runs into trouble. Secondly, it can be more tax efficient, especially at higher income levels, as profits are ring-fenced and you'll pay corporation tax instead of personal income tax on your profits. You can then choose what to take personally and when. And lastly, it boosts your business's visibility and credibility, which can make it easier to secure contracts, loans, or investments. But there's a catch. It's more complex and expensive to set up and run, first of all. Secondly, you do need to think carefully and plan how you will take your money out of the company. And also you'll need to file annual accounts and fulfill other legal requirements. You must file with HMRC as well as Companies House. And lastly, directors also have legal responsibilities that they have to comply with. Now we've covered the basics, let's talk about how to decide. Here are some key factors to consider with a few practical examples to help you. So firstly, income level. If your profits are modest, say under $20,000 per year, staying a sole trader might make sense. It's simple and the tax is straightforward. But as your profits grow, maybe over $40,000, a limited company can help you save tax by using a mix of salary and dividends. For example, earning $60,000 as a sole trader might leave you with a bigger tax bill compared to operating as a limited company. Secondly, business growth plans. If you plan to hire staff like a part-time admin assistant or even a full team, a limited company makes payroll and benefits management a lot easier. Expanding internationally or attracting investors. Most investors prefer dealing with limited companies because they're a formal structure. Risk. Now, sole traders are personally liable for business debts, so if your business involves risk, like working with expensive equipment, handling client funds or large projects, a limited company protects your personal assets like your home or savings. For example, if something goes wrong in a limited company, your liability is generally capped at the value of the company's assets. Then there's admin and costs. Sole traders deal with less admin, just a simple accounts and self-assessment tax return once a year. A limited company has more responsibilities. It has to file accounts with Companies House as well as HMRC. It has to manage payroll and keep detailed records. Are you ready to handle that, or can you hire help like an accountant? Credibility. If you're aiming to work with large clients, say in construction, tech or professional services, Many prefer to deal with limited companies because they seem more established. And then if you need a loan or funding, banks are often more willing to lend to limited companies because they see them as lower risk. Let's quickly break down the difference in how you're taxed as a sole trader versus a limited company. As a sole trader, you and your business are the same legal entity. So this means you pay income tax on all your profits through something called self-assessment. You'll also pay Class 4 national insurance, and the more profit you make, the higher your tax bill. Simple, but everything is on you personally. Now, with a limited company, the business is a separate legal entity, kind of like you've created a brand new person. It pays corporation tax on its profits, which is currently lower than the higher rates of income tax. You, as the owner, can then take the money out in a couple of ways, like a salary or dividends, which are taxed differently. This setup can save you tax overall, especially if your profits are higher, but it comes with more admin. So, to sum it up, sole trader taxes are straightforward, but you're taxed on everything personally. Limited companies can be more tax efficient, but they come with extra responsibilities. Pick the one that suits your business best. I'm going to put on screen some examples at different levels of profit, showing what the take home would be in these examples. So these figures are for the new tax rates from April 2025. Scenario A, sole trader. This is for sole traders. You pay income tax and national insurance on all your profits. Scenario B, a limited company, only one director on the payroll. This scenario applies to a limited company with just one director, typically taking a mix of salary and dividends for tax efficiency. Scenario C, limited company with other employees earning at least $6,396. This includes a limited company with other employees on payroll, such as a spouse or team member earning at least $6,396 annually. There are also other options available for limited companies to reduce tax efficiently, such as contributing to pensions, claiming certain business expenses, or investing in research and development. We'd always recommend seeking professional guidance to tailor this to your situation. So, how do you decide? So firstly, speak to an accountant for tailored advice. We'd be happy to help. Secondly, you can use online tax calculators to compare your options. And thirdly, think long term. Your needs now might change in a year or two. So choosing the right structure depends on where you are in your business journey. If you're starting small, then a sole trader is simpler. If you're planning to grow or protect assets, consider a limited company. Thanks for watching. If you found this video helpful, give it a thumbs up and subscribe to our channel for more business tips and advice. If you have any questions regarding choosing the right business structure for you, drop them in the comments below. See you next time.